to trickle in.
Sounds good.
People are running a bit behind. How are you today?
Good. How are you guys doing?
Good, very good. Is it a busy day?
Yeah, somewhat. It's a little bit of a busy week.
Yeah.
Yeah. What about for you?
Yeah, it's been busy. It's been good though.
Yeah.
It's been good. Yeah. The weather has been wonderful.
I know. I think everyone's in like summer mode now.
Good. Yeah. They're in mode for where do I go? Where can I go?
Yeah.
Go. Well, the background looks a little bit lighter on yours. Did you?
Yeah, I didn't do. I just copied the one you sent me.
Yeah. No,
Mine's
it looks
white.
good though. Yeah.
Okay.
No, it looks good. Cool. Cool. I'll go ahead and give it one more minute and then we'll go ahead and get started.
Sounds good.
Good. Cool. All right. Welcome, everybody. I'm going to go ahead and get started, and we'll let everybody else trickle in a few minutes here. So I just wanted to thank everybody for connecting with us today for our Women in Financial Empowerment webinar series. We will start with some housekeeping information, then we'll tell you a little bit about WomenIN, and then introduce our guest speaker. So we're going to be monitoring for any comments and questions for today's presenter, so feel free to use the chat window. We have gone ahead and muted everyone just to make sure there's no background noise or distractions. And I did want to quickly welcome MegaPixx Media, who is broadcasting this webinar live as well as recording it. So a little bit about WomenIN. We are an inclusive community supporting today's women and working together to build the women of tomorrow. We connect women aged 20 plus to our hub of events, networks, resources, and leadership. So today's speaker is Kalee Boisvert. Kalee is a financial advisor at Raymond James and has been in the financial industry for over 13 years. She's the creator and host of the Wealth and Wellness podcast, and she's currently writing a nonfiction book about money designed to empower and inspire women. She is the proud mom to a young daughter, and she is passionate about supporting women to own their roles as serious earners and smart investors. Welcome, Kalee.
Thank you so much. And I'm so glad to be part of this. And I love the whole series that you guys have been putting on this month. It definitely is my passion area about empowering women, especially when it comes to their finances and money and all those sorts of topics. So I'm going to go ahead and share my screen if that's okay. I have slides, so I'm going to go through these slideshow from beginning. So yeah, it sounds like at the end, we're going to go through questions. So definitely ask questions and have those ready.
This meeting is being recorded.
And I'm happy to answer those throughout. So today's presentation is, oops, from beginning. Okay, is that okay now? Looks like I got kicked out for a minute. Okay, so the topic is investing doesn't have to be scary. I do believe that we do a good job of making it maybe overcomplicated, and as a result, it can be quite intimidating. And not as much of a, comfortable atmosphere as we'd like. So I'm hoping to kind of create investing as more approachable and something that doesn't feel, scary as something out of reach or anything like that, but something where everyone belongs and it's comfortable. So a little bit about me. Thank you again for the introduction. That summed it up really well. I am very passionate about numbers and investing. My mom tells me a story when I was 4 years old, and she asked me what I wanted to do when I grow up. And I said I wanted to collect money. So I guess I'm living that dream now, because at the time she said that doesn't exist, Kalee, and that's called a bank. Well, little did she know I'd grow up to be a financial advisor and get to kind of step into that role. And a big part of, my passion and what I do is specifically helping and supporting women when it comes to their money. I grew up or was raised by a single mom, and money was really a source of stress and struggle. And that's what I saw a lot of growing up. And I knew coming into this industry, being someone who loves numbers, finances, and money, that I specifically wanted to help women in that realm, because I didn't want women going through what my mom went through. So I'm passionate about financial literacy. I do monthly lunch and learns on different wealth and wellness topics. And I used to do those in person prior to COVID, and then I took them online, and they're all virtual still. And so if anyone's interested in learning more about those, definitely reach out, and I'm happy to add you to my invite list for those. I do believe strongly that there is this link between our net worth and self-worth, and that's kind of the wealth and wellness piece that I like to incorporate. I think the idea of living, a wealthy life, we have to also be paying attention to how we're feeling, and how, we don't want to be just working nonstop, lots and lots and lots, and not having balance and time for family and hobbies and things like that we enjoy. So that's where I kind of see that the wealth and wellness piece coming together, because money is nothing in itself. I like to say, really, it's what it affords us the ability to do, whether it's adventure or security or freedom. That's really what we're trying to achieve with money. It's not just, collecting a stack of money. And, that's not what's going to bring us the ultimate happiness. It's what it's going to provide in our lives. And yes, as Tara said, I'm the creator of the Wealth and Wellness podcast. So again, I love that financial literacy piece, and I wanted to create a resource for people to access it on the go, whenever they have the time, because I know we live busy lives and it's hard to make time for this stuff. So I'm trying to kind of put it in different formats to make it easy for people. So before we start talking about investing and making investing less scary, I thought it was important for us to differentiate between, well, what is investing? And I think the best way to really make it stand out or differentiate it would be to look at savings versus investing. So the two are quite different. Savings would be more so about preserving your money. It's setting aside unspent money to protect it. And it's usually more of a short-term goal that we have in mind. So we're saving money maybe for an upcoming payment we have to make, or an upcoming vacation or something like that. And that's our savings that is accumulating. Whereas investing, it's a little bit different, because it's expecting a profit. It's actually putting our money to work and hoping that it's going to grow and appreciate in value. And usually then there's a bit more of a longer term time horizon on it for that reason, because it's not like, oh, I'm going to need this money next week for my vacation, but I'm going to go throw it in the stock markets and see if I can grow it until then, because that would obviously be a very risky strategy. So that's kind of the difference between the two. So investing is more so when you're putting money to work, when you're expecting it to actually grow and build. And so why would we invest in the first place? So why do people invest? Well, really, we have to look at the effects of doing nothing. So if we are not investing our money, where we have more of those long-term goals, maybe it's saving for your children's education, maybe it's putting or buying a home and saving up a house down payment, maybe it's saving for your retirement or your financial freedom. That's really a big one, and that's the kind of main one, I think, for most people. But so if we're going to do nothing, well then, if we kind of just have it accumulate as savings or not actually growing, well, as inflation is happening, our money is actually losing value. So if we think about inflation, this chart gives a really good representation of what that would look like. So even at just 2%, which is been sort of historically where we've seen inflation at. If we have $10,000 today, well, it's not going to be worth the same in 5 years' time, 10 years' time, 15 years' time. It actually loses a lot of its value. And the idea of inflation is, think, you go to the grocery store and you're able to buy this many bags of grocery for this much. And then kind of 10, 20 years from now, obviously, that's going to cost a bit more, or how we've seen, price of clothing go up, price of gas that goes up, price of food that goes up. That's inflation. So if we do nothing, we're actually losing value because of that. So this gives a really good representation of that, and a reminder then of why we need to invest to at least make our money retain its value and, not be lost to inflation, and maybe actually exceed inflation too. I wanted to point out as well that investing is available to anyone. So the stock markets and investing, it's been a very male-dominated industry for some time now. And to me, it goes back to, this, like the movie Wolf of Wall Street. I think that gives good representation of sort of where the stock markets were years and years and years ago. It was about this, stockbrokers call you up and say, buy this stock, sell this. And if you've seen the movie, you can see that it was just very much a male-dominated space. And as a result of that, I think as women, we haven't had as much time to get that comfort level and to maybe feel that same sense of belonging. So I do want to have that reminder of it is available to anyone, not specifically for certain people, especially thinking like some of these myths and fears about it. So that serious investing is only for really wealthy people. I need to get started or work with a professional. I'd have to have a certain amount of knowledge before I'm able to invest, or just simply things that I often hear. And unfortunately, I hear these things more often from women, but saying things like, I'm not good with numbers, I'm not good with math, money just isn't my thing. Well, that's not necessarily true. And if we, put these limiting beliefs and statements on ourselves, it's not going to help us progress and move further. And I too was very intimidated from the investing realm when I got started. And this is coming from someone who, like I said, I loved money from when I was a kid, but and even through school, I took finance courses, I did a business degree. And so I was so exposed all along the way. And then I started working for a financial firm, working with an advisor, and I started in the industry. And only then did I really get started investing. And I mean, technically I could have started earlier on. I could have started in my university years or something like that. I was learning all about it. I was in the courses I was doing, but I didn't feel comfortable. I didn't think that I could. I thought I'd need a certain amount of money, or it's only like these same myths. I didn't believe that it was possible for me. So I think that this is a really important piece for people to realize, is that these are myths, and you don't need to have a certain amount of money. You don't need to have a certain amount of knowledge. It really is available to anyone. So compounding growth, this is really the magic and the purpose of investing, is this growth. And, our money's growing. So again, savings, our money isn't really growing. It's just sitting there as, in a savings account. Versus investing, we're expecting a profit. We're expecting it to grow. So that's really the difference. And this compounding growth slide really helps emphasize, what that can look like. Because oftentimes I hear people, go, well, I don't really know what kind of return I'm making, and thinking it doesn't really make a big difference. Well, this really emphasizes that it does. So just investing $100,000, obviously at 0% rate of return, you're going to still have your $100,000 at the end of the day. But if you're even getting a 2% rate of return over 30 years, that's what it can look like. At 5%, that's what it can look like, 7%. So even comparing those two columns and saying, wow, between 5% and 7%, which is only a couple percentage points different, it's almost double the difference. So we have to be mindful of our rates of return, and they actually really do matter. So that's something that we need to be cognizant of. We don't want to be writing that off and just saying like, oh, I think it's growing and it's maybe doing about this percentage. That's a big piece because of compounding growth and the power of compounding growth. Like in this example of, 5 years, it grows to at 9%, 150,000. But then look at it in 30 years time, your $100,000 grew to over $1 million because of compounding. So that rate of return and compounding growth is so important. This slide is really just to remind you that, the power of investing is this reminder that you don't have to put away the amount of money that you might need to reach your financial goals. So let's say you've done like a retirement calculator and it says, well, you need $1 million. Again, this is just an example because it's very different for everyone. But let's say the output is you need $1 million, and then, it's very overwhelming and you start wondering, well, how the heck am I supposed to put away $1 million? How do I save $1 million? That's a lot of money. Well, this just shows that if you were to invest $200 a month at the age of 25, starting from the age of 25, you've only invested $96,000 up until the point where you're 65 years old. And at that rate of return, you have almost $1 million. So you never had to put away $1 million in this case, because the person started early, they put $200 away a month, and they were able to achieve almost $1 million. So investing is a big piece of how you're going to grow your wealth, instead of saying, I need to save up, or I need to have $1 million, or whatever that number is for you. Well, you don't have to do the work or not all the work, because investing is there working for you and it's helping grow that value. So this just gives, again, a different age rates, age ranges. So starting at 30, what it would look like, starting at 50. So there's still, again, it doesn't mean that if you're 50, it's too late versus if you're 25. It just shows that it's even more powerful if you can start early. So again, a reminder that, it's never too early to start, or always start where you are versus, waiting. So then let's talk about how we can make investing less scary, because I've hopefully shown you sort of the power of investing and how it can really grow your money and work towards building your wealth. So if some of what's, holding us back from actually doing it in our lives, because there's, visual proof that it's almost a no-brainer of, okay, let's invest then, it makes sense. But, like I said at the beginning, there's these fears, there's these insecurities. It can be an intimidating thing to be doing. So I'm going to go through each of these points in the following slide about how we can make investing less scary. So first off, I want to talk about paying off high interest debt first. So we love compound interest when it's working for you. And those charts all really showed the power of that and what that can look like. But again, the reverse is true if compound interest is working against you. So that would be in the form of holding a balance on your credit card, for instance. And here's an example of what that looks like. So if you have a $5,000 credit card balance at about an 18% interest rate, if you're just paying your minimum payments, it's going to take you 46 years to pay it off. And over that time frame, you've paid over $13,000 in interest. So you've essentially paid more interest than you even had borrowed to begin with. And it took a very long time to pay that down, obviously. So I like to think of, bad debt or high interest debt. We call it it goes by different names, but they mean about the same thing. I classify it personally as double-digit interest rate. So that's kind of that bad debt. So that would be high interest debt, like what you're going to see on a Visa credit card or a credit card in general. Maybe certain loans, if you're weren't approved at sort of a preferred rate and you have a higher rate they give you, and if it's double digit, 10, 11, 12%. Because how you look at this is you would have to exceed the interest rate on your debt to justify investing over paying down your debt. So if you're carrying a balance on your credit card and you're saying, well, I'm supposed to get started investing, and investing is really important. Well, the balance on your credit card is accumulating at 18% interest. If you can't get better than that in your investments, you were better off to pay that down first. And then once that's paid off, then start investing. Because that does make investing quite scary if you think, oh, I have this credit card balance, but I want to invest. So I'm going to have to make more than 18% on my investments to really make the math make sense for me. That would be very stressful because you're probably going to have to do some high risk investing to even achieve and come close to those higher returns. Like we're talking 20% or something to make it make sense. So that this isn't necessarily true then though for good debt. And what we call as good debt is if it's on an appreciating asset, so something like a home. So mortgages are generally classified as good debt because you're paying down an appreciating asset. For the most part, historically, real estate has been an appreciating asset, so it grows in value. As well, we're in a really low interest rate right now for homes. So if you have a mortgage on your home and you're paying about 2%, can you do better than that in the markets? You likely can. So it does mean that, well, I don't have to pay off my mortgage fully before it makes sense to invest. Because if I can just achieve on an annualized basis better than that 2% I'm paying over here, I will be better off and I will actually have more money in my pocket. And, you can do all sorts of things with that larger amount you've grown. Maybe you've, taken that time to grow it and your mortgage term comes up and you take some of that excess and put it down as a lump sum. So again, paying off high interest debt is important to making investing less scary, because if you're carrying that debt and trying to outperform it in the markets, it's going to be, a very tricky thing to do. Investing or gambling. So it's important to ask yourself, am I investing or am I gambling? And get clear on your intentions, because they're not the same. And it's when we think they're the same that investing becomes very scary. So investing is not gambling and gambling is not investing. Those are two separate things. And if you, like I said, if you do confuse the two or blur the two, then investment feels, well, this is risky and why would I be putting my retirement savings towards this? But that's not what investing is at its core. Investing is, it really goes back to this almost like Warren Buffett style approach to looking at a company. You're looking at the company and viewing it for, is this company going to grow? Is it in a healthy financial position? Is it going to keep adding value and expanding internationally or whatever, depending on the type of business? That's what we're looking at an investment. When you're going to make an investment, when you're going to invest, think of it as like you're the bank and you're the one with, with all the money, and you're deciding, well, who would I lend my money to? And then if you're looking at it from that perspective as investing that way, you're only going to lend your money out to people that, are high quality borrowers, people that, you don't think they're going to go out of business anytime soon, that they're going to be able to pay down their debt, all those things. So again, hold your money and look at your investments as when you're investing as if I'm making an investment into this. So again, you're playing the role of the banker deciding who's going to get my money. And so that's really the difference between investing and this gambling that we see more of going on recently with, these online events that are happening where people are talking about buying certain stocks, the emergence of these meme stocks. Almost like an investing FOMO is coming out from that and say like there's this fear of missing out on these, but they're investing and pumping these companies that there's maybe not that same value to. For instance, one that's really been popular, getting a lot of news recently is AMC. And if we look again at AMC, are you investing or are you gambling? If you're gambling, you're looking at it, are you okay with losing your entire investment? So if you're going to invest in that type of investment, know that it's more so a gamble, and whatever you're putting in, are you willing to lose in its entirety? If the answer is no, then you probably want to stick away from those type of investments and invest in something that is more aligned with what I described, is that understanding, is this a good company? Are they going to stick around? Are they going to be here 10 years? Like they're pumping AMC and the stock price has increased dramatically. But if you look at the financials, $5 billion of debt, they have $5 billion of forward leases that they've committed to. That's $10 billion of money they're on the hook for, and they don't have cash. So I can tell you that much. So if we're looking at it from the financials, there's not really a lot to justify a stock price like that going up. Again, it's being promoted or pumped on other things right now. So again, are you investing or are you gambling? I'm not saying anything against doing the gambling, but again, it's if you're doing that, know your limit, be okay with losing it all. If the answer is no to those, then stay away from those type of, I wouldn't want to say investments, stay away from those type of things going on in the markets and stick to the investing. Diversification. So another way we can make investing less scary is by diversifying. So it's that reminder of don't put all your eggs in one basket. And it doesn't guarantee you against loss, but it really helps to minimize your risk. Because think of it as, okay, if you have, a certain amount of money that you're looking to invest, if you put it all in one company versus if you put it in 20 different companies, the difference even just that would have, because the probability of one company, facing financial hardship or going out of business, it's probably like it could happen definitely for any one company, but could that happen for 20 companies and all at the same time in your portfolio? Highly unlikely. And then as we get that number even bigger, something like an investment in the S&P 500 means you're investing in 500 of the largest US companies. So if you have that held in your investment account, what are the chances of all 500 companies going out of business tomorrow? Well, it's really slim. So that's really the big risk of investing, right? Is losing your entire value of your investment. There will be ups and downs in the stock market, but if you put $5 in investment, technically, theoretically, it can go to zero. So you can lose up to your full investment. So diversification, it's going to help really minimize or reduce some of the volatility. And diversification, we can look at by country, by type of investment, number of investments, like the example I gave, holding one stock versus holding 20 or holding 500. Country is a big one. So here in Canada, we often have very much a home bias as investors. So investors are very invested in Canada, which is, great. And I'd like to see us being patriotic. But when it comes to growing your wealth and, you don't want to be invested in just one country, you want to have that diversification. So then if one country is, struggling for whatever reason, if maybe, here in Canada, we're more industrials and we're more based in like oil and gas industry and things like that. So when those industries struggle, our economy struggles, versus if you're invested in another country, they might not have the same exposure because those might not be their main sectors. So that's the benefit of diversifying. And then of course, buying ETFs, exchange traded funds, and mutual funds are going to help a lot, because each mutual fund and ETF is a blend and a mix of 50 plus holdings. So those right off the bat are giving you a good level of diversification. A rule of thumb I like to use is trying to make sure that you don't have more than about 5% of your overall portfolio invested in just any one individual stock. So it doesn't mean, if you have a mutual fund and you have more than 5% in it, again, that's okay because there's 50 plus holdings in there. But if you have one individual stock, try to aim for that 5% max of your overall portfolio that it represents. And this is really true when it comes to like company stock options and company stock. Oftentimes, that can represent a very large portion of someone's overall, net worth as they start to accumulate those. So just be diligent or be cognizant of that and kind of have a plan for starting to scale back and making sure that you're diversified. And this really represents why we diversify. So it's hard to make sense of it, but all you're trying to do here is pick a color that is consistently on the very top, which would be the best performing in a particular year. And really, you can't do that because you see them kind of, rotate. So in 2011, Canadian bonds were the best performing investment. But then in 2012, they went back to being almost one of the worst. And then the same for the following year. So, well, it wouldn't be good to have all your investments here in Canadian. In this year, it would be, but then 2012 and 2013, you'd be better off in these other types of categories. So that's why we diversify. So we have some from each of these blocks, and we're not getting that big, volatile up and down as if we were just holding sort of one sector or one asset allocation. Another way to make investing less scary is to just keep investing. So invest periodically. We can't predict with 100% certainty where the markets are going. I've been in the industry 13 plus years. There's people that have been in it well longer than me. None of us can with 100% certainty tell you what is going to happen in the markets. So I like to remind people to kind of, let's put our focus then on what we can control. What are some things we can control? And one of the things we can control is to just keep investing, is to just keep savings. So it's that pay yourself first, where, you have paychecks coming in, maybe it's the 1st and the 15th of the month, and you take $300 off the first pay, off your paycheck on the 1st, and you put it towards your TFSA. And on the 15th, you take 300 and you put it towards your RSP. And you're just investing on an ongoing basis. Because we get too caught up, I think, in trying to think we can time the markets. And that's a lot of what people are trying to do now. I see a lot of, especially because the markets have gone up a lot. So there's a lot of people that have decided, okay, I'm going to wait till they go back down. Well, you could be waiting a month, you could be waiting a year, you could be waiting 5 years, you could be waiting 10 years. We don't know with certainty what's going to happen next. So instead of trying to time it and put that stress on you of, again, a question or a scenario that none of us with 100% certainty know the answer to, keep investing on an ongoing basis. And so what you can see in this graph is just the idea of the stock markets. It's still, it's an upward trajectory, but there have been moments where it has pulled back and gone back down and then back up again. Here, 2009 here, this one, it would have been the financial crisis. So it went up this much from this dip right here, went up, down this much, but it did come back to gain everything back, did a little bit pull back here again, gained again. So if you're investing all along the way, you're sometimes adding here, oh, I added a couple hundred here. That's, that was the most expensive point at the time. But then I also added all along the way down here, and you're starting to smooth out your return numbers. Because if you can start buying kind of all along the way, you're taking advantage of these dips as well. And so that's that idea of average cost basis we talk about. So it's just averaging in. It means you just continue to buy on an ongoing basis. That's really a good thing that I think any investor can do. It takes the guesswork out of it. It takes the stress out of it. And again, it makes it less scary. You don't have to think, oh my gosh, I have to find, this point right here when it dipped on March 9th. And I have to make sure that I'm investing all on that day, because really it's not possible to do. And this is a really good illustration of that. So this is saying if you had $100,000 invested from 1998 to 2020, if you just stayed fully invested, you've increased it to, what is the amount it says? You've increased it 173% in value, versus if you just missed 5 of the best days. So if you were trying to time the market and you said, oh, the markets are going down, I'm going to pull out of the market, and then I'm going to get back in when they're going back, at the best part in the market. Again, really hard to do. And, you try to do that and maybe you miss some of the good days in there. And so just missing 5 of the best days drastically reduces your return by 100%. And then again, all the way to, if you missed the 60 best days, you're actually down in value your portfolio. So this illustration or this chart is showing you don't have to time the markets, and you're better off not to try to time the markets. So here's the proof that you might need to say it's not about finding the exact moment where I should buy in the markets and sell in the markets. And my investments are only going to do well if I do that. No, not at all. Your investments will do better if you do not do that. And that's what this shows us. And then know thyself. So another way to make investing less scary is to just really take time to get to know what you want. What are your goals? What are your desires? What are your dreams? Getting very clear on those. Too often I see when it comes to money, it's almost like reactive, and we decide that it's happening to us. So it's, well, I don't know when I will be able to retire, or I'm never going to be able to stop working. Can we turn that around and say, I want to retire at 55, or I want to make sure that I'm financially independent. So by the age, or when I'm in my late 50s, I can, stop working, or maybe I'll just do contract work, or maybe I'll volunteer, or maybe I'll have a part-time job, but I won't rely on the income. I won't require it because I'm financially independent. So taking time to get clear on your goals. And this is with any of the personal growth and personal development, they always talk about you have to have clear goals and a vision to work towards. And the same is true with your money. It's not it's not happening to you. And it's not just, well, whatever comes at us. It's, how can we be in the driver's seat? How can we be dictating what is going to happen? What do I want to see happen? And along the way too, I want to just emphasize embracing your money uniqueness. So we also get very hung up on comparisons when it comes to money. And this is just such an important reminder that we're so unique when it comes to money and money goals. And I've met with many people over the years in my business, and there's no two people that have had identical goals and identical timeframes or anything like that. There's no like sort of cookie cutter solution I could have made and just every person that came to meet with me, because everyone's, what they want to achieve, what they want to do. It's very unique. And I not get caught up in this, what I'm supposed to be doing, what I should be doing. This is what everyone else is doing, and make sure you're just really going, what do I want? What is it that I want from my money? And if we can do this and ask yourselves these questions, investing will be a lot less intimidating, because when you really know yourself and what you want to achieve, then investing's easy, because we just pick the things that are going to align with what your goals are. So if someone's very clear on what they want and when they want it, so they say to me, I for sure want to be financially independent at this age. This is how much money I have. This is how much I intend to put away each month or whatever. Then, there's the entire investing landscape out there, and there's definitely something that's going to make sense and work for them, versus just investing again, like that Wolf of Wall Street view of investing, where we're just calling up clients and blindly pushing product on them. It should be the other way around, of when I fully understand my client and when they fully understand themselves, then we can easily pick and choose the right investments for the person. And again, this goes back to focusing on what we can control. So we can control your time frames, your goals, what you're putting aside, the saving you're doing. We can't control the markets. We can't control if they're going to go up today or down today, but we can control these elements, these inputs that you're doing. So really getting clear on your goals and what you want to achieve is so important. So obviously, when it comes to the investing, hopefully we've made it a little less scary, a little less intimidating. Well, the big question is then, well, where do I invest? And these are the two most common places. They come up because they're the most tax efficient places to be investing. So when it comes to investing, you need a place to invest. So think of your RSP and your TFSA as the shell. They're the container holding your investments. They're nothing in themselves. They're just a type of account. Just like at the bank, you can have a checkings account, a savings account, multiple different savings accounts. Well, an RSP, and a TFSA, so a registered retirement savings plan, tax-free savings account, those are just types of accounts. You can still, within these types of accounts, do all sorts of investing, whether it be individual stocks, mutual funds, ETFs, bond investments. So all sorts of investments can be done in these shells of, where we can invest. These come up as the best places to because of their preferential tax treatment. So an RRSP is tax deferred, meaning when I put money in an RRSP, I will get that tax I've already paid on it back. So at the end of the year, when I file taxes, I'll get a nice little tax return. For instance, if you're at the 30% tax bracket, you make $1,000 RSP contribution, you will get $300 back, because you've, CRA deducted it from your pay. You've already paid it in, but you put it in an RSP, so now you get it back. So tax deferred, because we'll now fast forward to retirement. When you start taking money out of that account, you will be taxed on it. But again, remember, you weren't taxed when you put it in. You got the tax back. So that's why it's tax deferred. So it's still a great place to invest, because you can have your stocks in there, your bonds, your mutual funds, your ETFs, and they're growing, and there's no tax you have to report. So let's say you bought a stock at $2, it went to $10. You don't have to report that. You don't have to say anything for CRA's purposes, because it's in this tax deferred account. You don't have to do anything about that. Tax-free savings account is tax sheltered, meaning there is no tax implications when you take the money out. So it grows tax-free inside. When you take the money out, there's no tax implications. The room accumulates since they've introduced these. So as long as you were 18 years old by the time they introduced them until now, you will have about 75,500 in room. That's what's accumulated. If you've used some along the way, you will minus that from your room. If you've never opened a TFSA account and you're opening one for the first time, that full room is available to you. Again, difference with RSP is that the room is different for everyone and it's based on your earned income. But TFSA, again, so I'm putting money in. I don't get taxed back for putting the money in like I did with the RSP, but I also don't have to pay any tax when I take the money out. So that's the difference between the two. I have a whole podcast episode devoted to talking about RSPs versus TFSAs. So if you want to know more about that, I highly recommend listening to that one because there's a lot of different sort of nuances. And I think I sort of cover a lot of them in there. So quickly, just type of investments. I'm just going to breeze through these because I give a longer bullets for each of them. But again, when it comes to investing, I'm throwing out all these words like stocks, bonds, mutual funds, ETFs. Let's kind of break down what those are. So when it comes to investments, I think of them as there being about 3 different buckets of investing. So there's your cash and equivalents, your bonds, and your equity. Cash, obviously very straightforward. It's, things like GICs, high interest savings. It's essentially just a no risk investment where you're earning a little bit more on your cash. So instead of it sitting there earning no interest, like you're probably going to get with a checking account, it's finding more of like a high interest savings or something like that, where you're getting, maybe 1% or something. It's very low right now based on interest rates. Bonds as an investment are essentially you lending money to government or a corporate borrower, and then they pay you a fixed rate of income over the term of the bond. And then at the end, they give your money back. So let's say Apple, for instance, they're issuing some debt because they want to introduce a new iPhone or something like that. They come to the market and they say, okay, we're going to issue this 5-year bond. We're going to pay you 4% over the 5 years. And you say, well, Apple's a great company. Yeah, I want to participate in that. So you buy the $5,000 worth of this bond. You get paid your 4% each year. And then at the very end, you get your $5,000 back. So that's very simply how a bond works. Equities and stocks. So again, same name, they can be used interchangeably. We call them both. It's when you buy securities of a company and you become a part owner of the business. So instead of buying the Apple bond, I can just go buy Apple shares. So I go to the market, I buy some shares of Apple, and now I've become a part owner of Apple. And when I buy shares, of course, I'm not getting that, guaranteed return like a bond has, where it's going to pay me the interest and pay me back. But I buy the shares thinking that, I want the company to do well. I want it to increase in value. So maybe I buy the shares at $100 and it's gone up to $130 now, and I've made some money on the increase in value. So that's what stocks are. Stocks pay dividends. Not all pay dividends. So there's a little bit of information about dividends. Again, it doesn't mean a stock is good or bad if it does or does not pay a dividend. It's just, it appeals to a different type of investor. Again, going to that know thyself. If you know your investments, you want them to spit off some income and that's important to you, then we're probably going to search for some good dividend paying stocks. That's probably going to make sense based on what you're looking for in your goals. So investment funds, want to briefly touch on just mutual funds versus ETFs. That's another investing concept that comes up a lot. So I just want to touch on that before we wrap up here. I wouldn't say one is bad or worse than the other. They both just have their own pros and cons. So mutual funds, to differentiate the two, I would say think of it as this. So mutual funds, think of them as actively managed. So when you invest in a mutual fund, think of it as having multiple people behind the scenes that are actively choosing investments. They're buying and selling, they're strategizing, they're saying, okay, this and this is what's going on with the economy. I think we should have more of this and less of exposure to that. So think of it as there's a bunch of people that are actively working hard to sort of manage what is within that sort of bucket or in the investing basket. So there is this active management. And then as a result of that team of people working behind the scenes, you are paying management fees. So there is an embedded fee to a mutual fund. And again, though, what you're paying for is this team of people actively working to buy, sell, make calls on what they think the economy is going to do and whatnot. versus ETFs, exchange traded funds. They're also a basket of holdings, just like a mutual fund, but there's not this team of people that are actively managed. ETFs are more so just developed with computer programs, and they just sort of invest accordingly. So the big difference between the two, think that ETFs are very passive, less active management, less people behind the scenes, and as a result of that, the costs are a lot lower. So the embedded fees are sort of very small. Now, those are sort of the historical sense and how you can look at the two. The challenging thing is the two have started to kind of blur together, which, is good in the sense of mutual funds are starting to see that they need to lower some of those embedded fees. ETFs are starting to see that maybe there is active management is beneficial for certain, types of investing and things like that. So they're kind of taking the best of each other's quality by doing that. So it's beneficial in that sense. But again, there's not that one is better than the other. They just have differences. And again, if we know your goals and what you're trying to achieve and your timeframes and things like that, then one of these is probably going to stand out as a better investment option for you, or maybe kind of a combination of both, depending. So to wrap it up, thank you so much for your time. If you're thinking, okay, now what do I do? I'm less scared to invest. I'm ready to go out there, get invested. Well, I would say just commit to expanding your knowledge along the way, because just like compounding money, there's compounding knowledge. So here's some ideas, listen to podcasts, read some books, start a book club, a money book club, get an accountability partner, someone that you can chat with on your journey. It makes it a lot more fun. Get invested. So do some investing. Start where you are, and anything is better than nothing. So instead of, getting really hung up on the, when I get this raise, when I learn something else, then I'll get started. Just getting started now. And remember, you don't have to do it alone. There's professionals out there. There's, family members, people that you can talk to as well. So never think that you're alone when it comes to these conversations. And that's it.
Thank you, Kalee. That was excellent.
Thank you.
We've got a little bit of echo going on there. Hopefully it's not too bad. I loved your comment regarding consistency is key. That goes down to the compounding and the time. So that was great. I think we've got some questions, Wanda, that we might want to have a look at here.
Yeah, we've got a few. I think one of them may have been answered already just with their presentation, but starting at the top, what are the questions we should ask our financial advisors to make sure we understand the strategies they suggest?
That's a great question. And I love that, because it's getting engaged and actually asking questions. So that is so important, because I think so many people think that they don't have the right to do that, or the financial professional knows best, and you're just supposed to sort of blindly listen to them. And so knowing that it's important to get engaged and to ask questions is just step one. Whatever questions come up, like any question is fair game. If there's something you don't understand, make sure you ask it. And I always say ask and ask and ask again until it makes sense, because again, we're so in it as like industry professionals that we use a lot of jargon and things like that. And if it's still just not clicking, it's like a math concept. Like I remember in math, you would learn a concept and maybe it didn't really make sense, but as you, maybe they said it a different way or gave a new example of it, then all of a sudden it clicked and you're like, oh, okay, now I get it. So asking them questions, whatever comes to mind, there's nothing off the table. Never think your question is a dumb question, because again, we use the jargon, we use a lot of these things where we just assume people already know the answer, and they don't. And so we need to open that up for a conversation to be had, because you are still part of the conversation. It's your money. And never forget that. So asking whatever's coming up, whether it's, rate of return, asking what are my fees? Are there any sort of embedded fees I'm paying that I'm not aware of? Those are some really good questions to ask. If you see something kind of happening with the economy, maybe it's how is my portfolio positioned, to protect against some of what might be happening, or if the markets pull back. So whatever comes up, though, I would highly suggest just asking whatever it is.
That actually leads nicely into the next question. A lot of people I've talked to are concerned about how much their advisor costs or if there's commissions. How does that work?
Yes, that's a great question too. And so it is something you need to be asking, and there's no, harm in doing so. It's important. It's tough because it's not easy and it's not a straightforward answer. The industry, again, we have a tendency of making things really complicated. So some advisors work on a commission basis, some work on a fee-based basis, some do a little bit of both. So it's not like there's one size fits all for advisors, but if you ask just, what am I paying? What rate am I paying you? They should be able to get you a clear answer for that. If they're commission based, they should at least be able to have like a summary of how much you've paid in commissions. The industry, what's happening is there's a lot of good coming in that way. It's something called CRM2 came in a couple of years ago, which means as an industry, we have to report what is being paid in fees. So at least on an annual basis, we have to give you a full summary of what you have paid in costs. And again, though, this has come down for my side of the industry, which is IROC licensed firms versus MFTA. So some of the mutual fund dealers, which means they can only sell mutual funds. This same regulation has not come down to them. So they do not have to necessarily report that. So the danger is a lot of people might be at the bank investing in bank mutual funds and thinking you're not paying any sort of fee, but there is actually an embedded cost in that in the form of an MER. So you can still ask if it looks like you're not paying for something. If you have some sort of financial professional or if you're with an institution, there is a fee of some sort. It's just a matter of what is that fee. Now, when it comes to what is the cost, again, all advisors charge different amounts. So there's no standard to how much we have to charge. So there's advisors that charge 2% on an annual basis, which I would say is a little bit high. And then there's ones that charge less than that. And so it is just finding the right fit and asking that question and finding out if you're comfortable with the number that comes out of it. And if you're not, and you don't want to have to pay any sort of fees, then there is the, other platforms that would work for you. So more of like a self-directed investing account where you're paying maybe $10 a trade or less, or a robo-advisor kind of account where you're paying maybe 1% or so in kind of like a Wealthsimple type platform. So there's a lot of options that exist there. So if the fee seems high to you, you can always interview other people, see if there's lower options. And then if it's something that you just do not want to be paying and you want to do more of it yourself, then that's going to really drastically reduce any sort of cost. But it's just important, I think, with the fee, we've gotten really hung up on the fee and cost. It's really understanding, well, what am I paying for? If the advisor is providing value, services, and growth beyond what you think you could do alone, and maybe they're charging you 1% or 1.5%, and it all seems justified to you, then by all means, that's fine. But if you're not really getting attention, they're not answering your questions, you don't hear from them ever, you're not getting any sort of financial planning, things like that done, and you're paying quite a high fee, then maybe it's an idea of, maybe I should look for another option. So unfortunately, there's not an easy answer to the question, but key is to just ask what I'm paying. Maybe they've told you before and just say, hey, I forgot. Can you tell me again, what am I paying in fees?
Great, thanks. Any ideas for how to transfer debt to lower interest rates?
Definitely if you can look into some sort of like debt consolidation. There's a few good companies here that do like consumer proposals and things like that, but they, you don't necessarily have to go down that path, but they would be good to advise on what exists or going to your bank. We are in really, a very low interest rate environment. So there's sometimes options where you can find a lower fee option. So you could transfer a balance to a lower option if they can give you a lower rate or something like that. But that is an important conversation to have, because if you can get it lowered by a bit and do some sort of consolidation on that, it can save you a lot of money on it. So like a consolidation loan, looking into that. Most banks offer them, and some of the more the independent financial firms as well. So looking into that, again, if you can save 5% interest or yeah, here or there, it's going to make a big difference on getting it paid down quicker.
And then the last question is, investing is often considered synonymous with buying RRSPs. And I think it becomes intimidating. So what other investment types should and could be considered?
Yeah. And that's the thing I want to like point out is that when people say buying RSPs, it's not really a correct statement, because you can't buy RSPs. You can contribute money to your RSP account, because again, when we look at it, it's just an account type. It's nothing in itself. It's just the RSP is just the shell. So if you make an RSP contribution, it would literally be me putting money into my RSP and it's sitting there as cash. That's an RSP contribution. So it's not actually invested, or it's not actually doing anything until we actually put it to work and invest it. So you can put it in a mutual fund, you can put it in an ETF, you can put it in an individual stock. So you can have your RSP account and you can have Apple stock, Amazon stock, Facebook. I'm just naming random companies. TD Bank stock, Royal Bank stock. You can have all those sorts of things in your RSP. I think because especially like RSPs and TFSAs, people think that they have to be in certain investments, or you just have to take what the bank gives you with their more limited offering of investment products, especially with a tax-free savings account. So oftentimes the banks encourage you to open a tax-free savings account, but they don't have the ability to hold any types of investments, and all you can hold in there is cash. So it's kind of, again, a misnomer. A tax-free savings account makes it sound like it's just a savings account, but it should be called a tax-free investing account, because you can do all sorts of investing in it, and that's when it really adds value. So when you open a TFSA, if it's a direct investing account, you can buy, again, the individual stocks. You can buy an S&P 500 ETF. You can buy a Fidelity mutual fund. You can do anything under the sun in that TFSA. You can do anything under the sun in the RSP. So you're not restricted or limited. You're only restricted or limited probably by the financial institution. So if you're doing it at the bank level, they might say, no, all you can buy is from this, list of 5 mutual funds. Well, if you went and opened your own direct investing, or if you worked with like a full service wealth management advisor like myself, we can buy anything that exists as far as investments. So yeah, we get caught up thinking that you can only do certain things. So RSP is still great. Again, it's just the shell. It's just the investment account. What you do inside of it can be anything. Like there's people that have RSPs with 20+% returns, and there's people that have RSPs that have 2% returns, and they have, GICs or things like that. You can do anything inside of there. Again, it goes back to knowing your time frame, knowing what you're trying to achieve. An RSP is still a great vehicle if you're young, you're putting money away from your retirement. You get the tax back, which is nice, and then you pay it later on when you pull out. But let's say you're at the 30% tax bracket right now. I'm getting my 30% tax back by putting money in the RSP. Investing it is growing tax-free. Now fast forward to my retirement, I'm at the 20% tax bracket because I'm making. So I've literally saved myself 10% there. So it still made sense to put money in the RSP for me. I got my 30% back, paid 20% on. CRA is still out 10% from me.
Great. That's the last of the questions I've captured from the chat, Tara. Anybody else have any they'd like to ask?
Feel free to unmute if you have any final questions before we go ahead and sign off here. Oh, there we go. Looks like we got one more. Critical to build a trusted relationship with your advisor. Absolutely.
Yeah, that's a great comment. I love it. It doesn't have to be that you just get the person that's assigned to you or who you've ended up with. It's a decision and a choice, and you get to be the interviewer too. You get to interview who you want to be in that role. And if it suddenly doesn't work and you don't like it, you get to, fire that person. You can do it in a very kind way or whatever, and you get to move on and find someone that is a better fit. Because again, it's your money. No one's going to love your money as much as you, but you need to find sort of the person that is looking out for your best interest, that is the right fit. So it's interviewing a few people, finding what is the right fit for you. It's not about just staying with the person that you ended up with.
Absolutely. I know one of the big ones I've heard is making sure that you're in a relationship where the risk tolerance is the same, because that can definitely be a bit of a sticking point if one or the other wants to be riskier than the other. So that's a very good point. Have a good relationship.
Yeah, absolutely. Love it.
Perfect. I think that's everything that we've got as we're hitting on 1 p.m. now. So I wanted to thank you, Kalee, for a wonderful presentation and thank everybody for participating and hearing everything today. If you want to connect with Kalee, feel free to look her up on LinkedIn and we will be sending out a survey. So again, thank you, everybody, and have a great